Stock declines and volatility accelerated into the close on Friday. The S&P 500, Dow Jones Industrial Average, and Nasdaq Composite were all monkey-hammered. The S&P 500 ended down about 8.8% for April. That posted its worst monthly performance since March of 2020. The Dow dropped 4.9% for the month. However, the Nasdaq Composite was the worst, sliding by more than 13% in April. This was the Nasdaq's worst month since October of 2008. And Treasury yields continued to climb, with a 10-year yield rising above 2.9%. Volatility has continued, with more concerns over whether tighter monetary policies from the Federal Reserve might derail the economy. And of course, these fears were compounded with jitters over persistent inflation, geopolitical turmoil, and the ongoing virus outbreak in China. There's lots of re-rating going on, whether it's the re-rating of equity valuations, the re-rating of interest rate expectations, or the re-rating of inflation expectations. So far, a 50 basis point hike is now a done deal for next week's FOMC meeting. However, it appears the market is struggling with a 50% chance of a 75 basis point hike in June. And no, the equity markets have not priced in that level of hawkishness, at least not yet. But we now have a new entrant into the market struggle. As reported on Thursday, the U.S. economy contracted for the first time since the second quarter of 2020. The government data showed that GDP shrank by 1.4% in the first quarter, and the weak GDP print may suggest that members of the Federal Reserve should exercise more caution as they prepare to raise interest rates. Although we have chaos, keep in mind that as a contrarian, these are the conditions that present opportunities. So, let's take a look at the charts. And we're going to look at two charts today, beginning with the 6-month daily chart on the VIX, the Volatility Index. And as you can see in the upper left, the symbol is $VIX using stockcharts.com. Now, in the middle portion of the charts here, going back to, say, late October into early November, you see these bottoms here where the basing was under that level of 16, but subsequent to that, we had higher lows all the way up here to this point, 20, and then we had the launch of the latest volatility. We're here at 33.4, which is high, but still not as high as we were back here in March and then here in January. So are we going to get up there? Well, it looks right now that we might be starting to roll over. If that's true, a rollover in the VIX means a bottoming and a basing in the markets. But we'll see next week. Now let's go to our other charts. And now for our second chart, I'm going to change things up a bit. We're going to be looking here at the 3-year weekly chart on the Fidelity Nasdaq Composite Index, the ETF, and the symbol is ONEQ, and this basically serves as a pretty good proxy for the Nasdaq. So the chart itself may have different numbering, but the formations are pretty much the same. Now, from this low here in early 2020, which was the coronavirus panic, say from that point there, moving on up this line through here, you can see that we breached below this upward trend line here. Now, is that significant? Well, to me, maybe. I don't think we're going to head much further down. I don't think we're going to have a crash. I don't think this is a start of a crash. I would be worried about a crash if we recover and head on up. Now, that to me is the probability, but it is possible that we could deteriorate from here and head on down much further. But there's been a lot of damage in the markets, particularly in the Nasdaq stocks. So I think we're nearing the end, and at least that's what the VIX is telling me. But again, there's the possibility we could deteriorate. Moving down here, you can see that the volume here is nowhere near it was when we had the coronavirus. That was much worse. So, to me, things are much more calm, but you would never know it if you took a look at the MAC. Here, you can see that we've come down way down here, much lower than we were here at that point. So, we had the maximum negativity there. We came up. We got an attempt to move up and through, but got reflected back. So we're going to give it a second chance here pretty soon. I would imagine, and I'm always early, it seems that way, but I would imagine here in the next few weeks we should be bottoming and basing. But you've heard that story before, so we're just going to have to wait for it. But I still think that's what the probability is. And you can see here in the histogram, maximum negativity at this point here. We've had a sharp drop in the last couple 3 weeks or so. Are we going to continue on down? It's possible, but I don't think it's likely. Now, going back here, definitely by the histogram, look here, much wider in width. It looks to be much worse, but certainly the depth does not seem to be much worse. We'll see where this goes. I don't think it's going to get as low as we did here, say in the February-March timeframe, but time will tell. I just don't think that's the probability. Here in the price rate of change, we're at a relatively weak level here, heading on down to this -10. We hit that at that point there in February. It looks like we'll do it again here. Hopefully we can recover and head on up, but this does show things are weak. Into the RSI, also we're at a very weak 27.58, these levels here, but not as far down as we were here in that time frame based on the virus. Now, it does look like there's a little bit of upward movement, but I'm not going to call that really all that significant. It might be a little trend upward beginning, but it's not much to gloat about. Moving on down here into stochastics, pretty much the same thing. Actually, this does not look like it's improving. It's continuing on down here, but a very long bottom and basing going on. Hopefully it ends quickly within the next week or two. Moving here into the Williams, pretty much the same thing. We definitely have had trouble for several months now. This is much worse than it was back in the virus outbreak at that point there. So certainly things are bad, at least for the Nasdaq. The other indices might not be as bad, but focusing on the Nasdaq simply because that's where some of these growth stocks may be opportunities relatively soon. Back up here into the price chart. So that's a question for you. On next Wednesday, do you want me to continue with the charts, perhaps going through the monthly, the weekly, and the daily, or do you want me to pick some stocks to start taking a look at? Let me know in the comment section. And for today, that's ChewDog Charts. Thank you.